In mass production, factories turn out thousands of identical items. Because every unit is exactly the same, accountants can easily calculate the cost per unit by taking the total factory costs and dividing by the total number of units produced. But you cannot average out your costs when building a completely unique product, like a custom yacht. Every vessel consumes materials, labor, and machine time at completely different rates. If you simply divide total factory costs by the number of boats built, you will grossly miscalculate the cost of each individual project. To solve this, manufacturers use a system called job order costing. This method accumulates specific costs onto dedicated job cost sheets, tracking the exact resources required for identifiable groupings or highly customized builds, like a bespoke run of custom jewelry. Tracking costs by specific job is the only way a manufacturer can accurately price custom orders and ensure true profitability on every unique project. For this tracking to work, the financial accounting system must perfectly mirror the physical production process happening on the factory floor. This flowchart illustrates the T accounts that act as the architectural map, translating that physical reality into financial data. For these inventory accounts, the rule is strict. Transactions recorded on the left side, the debits, increase the account balance. Transactions on the right side, the credits, decrease it. We will step through this map to trace the chronological life cycle of a single customized job, watching how costs flow from raw materials all the way to final sale. Mastering this visual map is essential for understanding how physical inputs are transformed into measurable financial value on a balance sheet. Step 1 begins when the physical inputs required for production are obtained from suppliers. This question shows the correct journal entry to record the purchase of those raw materials on account. We debit raw materials inventory to increase it, and credit accounts payable to recognize the liability. Step 2 happens when materials are requisitioned for the production line. The cost is credited out of materials inventory and flows downward, debited directly into the work-in-process account. Step 3 tracks the human element. Workers use time tickets to log exact hours spent on specific jobs, giving us our direct labor cost. Those direct labor costs then flow right into the work-in-process account, joining the direct materials. The work-in-process account now accurately reflects actual, highly traceable direct inputs of the physical product being built. But direct inputs are only part of the equation. While direct materials and labor are known immediately, actual indirect costs, like annual factory rent, insurance, or utility bills, are not known until the end of the period. To solve this timing issue, Step 5 uses a dual-track system. As actual indirect costs are paid throughout the year, they are temporarily parked in a separate account called Manufacturing Overhead Control. Meanwhile, in Step 4, we charge the specific job in progress using a predetermined estimated rate. This flows from the Manufacturing Overhead Applied account directly up into work in process. This problem provides a practical scenario for calculating a total product cost using an applied overhead rate. First, we accumulate the actual direct costs from the job sheet, $13,700 in direct materials and $4,800 in direct labor. Next, we calculate the applied overhead. We multiply the 800 machine hours the job required by the predetermined rate of $25 per hour, yielding $20,000 in overhead. We sum the materials, labor, and overhead to find a total product cost of $38,500. Dividing that by the 7,000 good shirts produced gives us a unit cost of $5.50. Notice that we completely ignore the administrative and selling costs listed in the problem during this calculation. Product costs only include manufacturing costs. Administrative expenses are period costs, and they are strictly prohibited from entering the work-in-process inventory account. No matter how perfect the costing system is, the physical manufacturing process inevitably creates waste. Accountants classify this waste into two distinct categories. Normal spoilage is the expected inherent amount of output that fails to meet quality standards in the ordinary course of production. Because this risk is an inescapable part of manufacturing, the cost of normal spoilage is absorbed directly into the cost of the good units. It remains inside the work-in-process account. Abnormal spoilage is waste generated over and above expected amounts. This is usually due to operational failures or avoidable errors on the factory floor. The accounting boundary here is rigid. Abnormal spoilage costs are immediately expensed as a period loss. They are permanently removed from work in process. This scenario shows how to separate normal from abnormal spoilage in practice for a telescope lens manufacturer. First, calculate the total units that must be accounted for. We add the 2,200 units in beginning inventory to the 4,000 units started during production, totaling 6,200 units. Next, subtract the successful output. That is 3,000 units transferred out, plus 1,500 units still in ending inventory. Subtracting those 4,500 good units leaves 1,700 spoiled units. Finally, we subtract the acceptable and normal spoilage of 1,000 units from our total spoiled units. That reveals our abnormal spoilage figure of 700 units. Properly categorizing this waste ensures that only expected, unavoidable costs inflate the valuation of inventory, preventing companies from hiding operational failures on their balance sheets. Returning to our system map for Step 6. When a custom job order is finally completed, all accumulated costs transfer out of work in process and into finished goods. In Step 7, when the job is sold to the customer, the cost is transferred out of inventory entirely and recognized as cost of goods sold. This leaves one required piece of accounting maintenance. At the end of the period, we have to reconcile the estimated overhead applied to jobs with the actual overhead bills that finally arrived. Overhead is considered underapplied if the applied amount is less than the actual costs. It is overapplied if the applied amount exceeds the actual costs. If this variance is immaterial, just a small dollar amount, the difference is simply closed out directly to cost of goods sold. But if the difference is material, it must be prorated back across work in process, finished goods, and cost of goods sold to accurately restate reality. Job order costing is the dynamic engine that translates the physical chaos of the factory floor, the raw labor hours, estimated utility usage, and expected waste, into precise, auditable financial records.